Hi, welcome to this Sphere Deck, which is on the 15th of January. We're on Wednesday. We're just going to be looking at a simple entry technique today, which you can incorporate in your strategy to basically catch market reversals. Now, this entry technique does not require much confirmation. It's a very aggressive trading technique, but if you do it correctly, it'll give you really low risk, high reward trades. Now, in relation to the trade entry technique, we're going to be looking at a pair today, which is CHF JPY. Now, in terms of CHF JPY, we're going to go and take a look at the trade setup right now. But please do keep in mind, it is my view. As of right now, it can, of course, change in line with the market conditions and action. If you want all our trading techniques, now daily technical sentiment analysis of 14 Forex pairs, you can get live access for a limited period to our member center on the link beneath this video. Right, we'll look at two charts. We'll look at the weekly chart very quickly, first of all, then shift to the daily chart and do our levels of entry, stop and target. Right, weekly chart. In terms of the weekly chart, what we can see is Swiss franc has moved up quite nicely. Last two candles, last 2 weeks, nice big blue candles, and the volatility has increased. Now, we will use Bollinger Bands to give us an idea of the volatility of the pair. For anyone unfamiliar with them, you've got two outer bands here in orange and a centre band in green. The wider the Bollinger Bands are apart, the higher the volatility is, okay? So you can see the bands widening out, high volatility. Now, in terms of you get outside of an outer Bollinger Band, you've got 3/4 of the candle outside. You're not normally going to stay outside for long on high volatility. To give you an example, here's one. Get outside of the band, exhaust, come back in, and you come back to the mean price, which is a 20-day moving average. Now, I personally think this rally is going to fail, and 110 is a good target. Now, in terms of where we are, we're just at a round number, which is 114. And 114, any round number is important because, yeah, you can have a lot of institutional order flow around this level. Now, are we going to break higher? We'll do the levels of entry, stop and target on the daily chart. If we break higher, I'll just sell back through the round number. If we don't break higher, my stop is going to be behind that level there. Whereas the target price is going to be initially the 20-day average, the mean, the 110 level. You can see actually 110 got above it there, rejected down, kind of held the price there, then up on the blue, now up again on two blues. Now, in terms of the technicals, obviously they do come out of the sentiment and fundamentals towards the pair, which I'm going to discuss as we do the daily chart, and we are going to go and take a look at it now. All right, CHF JPY daily chart. Now, obviously the Swiss franc ticking last week, a nice move up. The volatility has picked up. Why has CHF moved higher? Not just on the Japanese yen, but on all major currencies. Well, it's a knee-jerk reaction to the USA calling Switzerland a currency manipulator. That has panicked shorts. This is just generally across the board out of the CHF, and speculative longs have come in to buy it. Yeah, sure, that US has called Switzerland a currency manipulator, probably with justification. It's a knee-jerk reaction, and in our view, it just simply will not last. And now, in terms of why trade the CHF short and the JPY, well, JPY is the most oversold major at the moment, just generally in our view. And it's oversold on the US-China Phase 1 trade deal. A lot of optimism about that. That's due to be signed today. We think that deal is no more than a truce. There's nothing to boost global growth or global trade in it. Market's going to be disappointed, and the yen should spring back across the board. And yeah, we've got an oversold currency, JPY, an overbought currency, the CHF. Also next week we have the Bank of Japan, and we expect the Bank of Japan, I'll cover this in my weekly forecast, I did it in the last one if you want to go and check, but I expect the Bank of Japan to be very hawkish. The market expects them to be dovish. So that's a factor that will come into play next week. But in terms of the trade, Two candles outside the outer Bollinger Band pressing against the round number. How are we going to play it? Well, in terms of, let's say if we do break higher, let's say we break above the 114 level, we'll just sell back clear of the round number at 113.80. But what if we don't really get past the round number and reverse? We've had kind of vertical rise. You're outside of the outer Bollinger Band, and we'll just very often sell back through the outer Bollinger Band. If we do, our stop will be 113.80. 114.80. So well clear of that resistance level I drew on the weekly chart. If it gets above 114, we're coming through 113.80. Then basically the stop will be 115.20. If we rally on from 114 up towards 115, we'll just sell on any weakness that we see. Can't obviously say exactly how we're going to do it yet, because obviously we haven't broken higher, but breaking lower, we're just going to come back in the outer Bollinger Band. So 113.50, stop 114.80. Where do we think prices are going to go to? Well, you've got the mid Bollinger Band here. I think it is a big rise that we've seen. We do think the yen is going to mount a rally. Same level as on the weekly chart, 110. So for us, it's a very aggressive entry. It's really just playing Bollinger Bands, round numbers, and looking at the reasons behind the spike. But over the years, this trade setup has given us really good profits. It's got a really good risk to reward on it, because you've got well over 3-1 on it if you come in on weakness, and if it moves up a bit, that risk to reward will get better. It is very simple, but elevated price spikes or big price spikes and higher volatility, they don't tend to last. This one I expect to fade, so we'll see, but I'll update this pair in a future video, but that is the way we see it at this moment in time. Right, that is the video for today. Thank you very much for watching me. As per usual, take care and have a good day.